The screen turned blood red, and in 28 minutes, silver was slaughtered by $15 without a single warning. Every algorithm, every stop loss, every leveraged position, they all detonated at once like a chain of buried mines. Traders screamed crash, collapse, game over, and the world believed them because chaos always drowns out calm voices. But underneath that violent red candle, something invisible and ancient was already moving against the institutions. The $15 drop was not a market event, it was a trap door swinging open beneath every bank that still believed in control. Liquidity disappeared like water into sand, and price fell not from real selling, but from pure absence. In the cold silence after the crash, the real buyers materialized. No headlines, no announcements, no permission needed. Vault doors unlocked, delivery demands exploded, and paper promises collided with physical metal like two worlds finally meeting. By the time the average investor looked up from their phone, silver was already bleeding green on the chart. What the public saw as a recovery was actually the first breath of institutional death. The crash was manufactured to buy time for the banks, but it accidentally revealed exactly how little time they had left. Every ounce of paper sold during that $15 drop was an ounce they did not own, an admission disguised as aggression. When the expected avalanche of follow-through selling never arrived, the engineered smash turned into a vacuum. That vacuum began pulling in every available physical ounce at prices that history will never offer again. Sell algorithms fired into hollow order books, and price collapsed faster than any real supply could ever move. This was not distribution. This was a mirage shattering in slow motion. As the screens flashed red, physical dealers did the opposite of what the market expected. They raised premiums while chaos was still unfolding, because real metal was disappearing from shelves faster than fear could spread. That split, paper falling while physical prices climbed, was the first crack in the wall. It told anyone paying attention that the crash was entirely synthetic, disconnected from the metal that actually exists. Institutions anticipated that the violent drop would finally free their margins and relieve pressure on their short positions. Instead, clearinghouses saw the volatility spike and immediately demanded more collateral, not less. Rising volatility increased margin requirements even as price collapsed. The trap closed around the banks quietly, without any headline announcing it. Every futures contract the banks sold to push silver lower only deepened the hole they were already buried in. They were pouring gasoline onto the fire they desperately needed to extinguish. Retail panic selling was almost non-existent this time, because the retail holders had learned from every previous smash. Most of the physical metal had already left the system months ago, sitting in private hands that no exchange could touch. The crash did not reveal abundance. It revealed the terrifying depth of scarcity. And scarcity does not heal itself with lower prices, no matter how many algorithms insist otherwise. When silver finally printed its low, something unprecedented happened on the delivery side. Longs refused to roll their contracts forward and instead demanded physical bars, forcing the exchanges to find metal they had already promised to someone else. That behavior sent a tremor through every risk desk in London and New York. Crashes can be managed with more paper, but physical delivery demands cannot be faked, delayed, or invented. The $15 drop triggered an immediate wave of buying across Asia, where the clocks had not yet reached morning. Time zones became the bank's worst enemy because physical demand does not sleep on schedule. By the time Western markets opened for the afternoon session, supply across Shanghai and Mumbai was already spoken for. The rebound was locked in before any Western analyst had finished writing their crash report. Price turned green on the chart without any meaningful volume spike, which confused every trader trained on traditional market mechanics. This was not a trade happening. This was a permanent repricing of what silver actually meant. Institutions attempted a second coordinated push lower within hours of the first crash, and it failed instantly. There were simply no more sellers left to frighten into liquidating. Each failed attack on price confirmed the same quiet truth that no bank wanted to say publicly. Control over the silver market had already slipped away, and the crash proved it rather than restoring it. The rebound accelerated violently as short sellers began covering into extremely thin air. Every single buy order that hit the tape lifted price by amounts that would have been impossible in normal conditions. What looked like a sharp, V-shaped recovery on every chart was not actually a bounce at all. It was a structural break, the moment the market changed from one state of existence to another, permanently. Silver stopped functioning as a commodity traded on supply and demand fundamentals. It had become something far more dangerous, an escape door from a system that was visibly cracking open. Risk desks across the major banks began cutting their exposure, not because of the losses they had already suffered, but because of the uncertainty that made every future position a gamble. Uncertainty is the single most lethal force in a leveraged system. The crash destroyed every institution's confidence that they could control downside price. Without that confidence, the entire architecture of suppression begins to collapse on itself like a building with no foundation. Funds that had positioned themselves to buy the dip at lower prices were forced to abandon that strategy entirely. They had to chase price higher, competing against each other for a shrinking pool of available metal. The first green candle on the chart erased hours of carefully engineered fear in a single stroke. The second green candle did something far more devastating. It erased years of carefully constructed narrative about who controls this market. Media outlets shifted their tone within minutes, reframing the crash as healthy price action and normal market correction. Healthy markets do not rebound like detonations, and no serious person believed the spin. Every single dollar that silver climbed higher tightened the invisible noose around every legacy short position still open. Their exit doors had been welded shut by their own trades. Margin calls began arriving at desks that had expected the crash to provide relief. Volatility made survival in the market significantly more expensive, not cheaper, regardless of direction. Repo desks felt the pressure spreading through the system immediately like venom moving through veins. Cash was needed right now, not at the end of the week, not at settlement. Emergency liquidity appeared from sources that no one publicly identified or explained. The silence surrounding that liquidity confirmed exactly how severe the situation had become behind closed doors. The crash had not reduced systemic risk the way the banks needed it to. Instead, it had concentrated that risk into fewer hands, fewer positions, and fewer possible exits. When silver reclaimed the entire $15 drop and began trading above pre-crash levels, disbelief replaced panic across every trading floor. Disbelief is far more dangerous than fear because it freezes the decision-making process entirely. Institutions froze in place while price moved ruthlessly against them. That delay, measured in minutes, cost the banking system billions of dollars in forced liquidations. Physical buyers ignored the chart entirely during the rebound because they were not measuring their risk in ticks or percentages. They measured risk in ounces, in weight, in metal they could hold and no algorithm could take. Every single dollar that silver recovered validated the thesis of physical shortage more powerfully than any research report ever could. Nothing convinces the skeptic like price moving against their position. The rally became relentless because it was completely unopposed by any meaningful supply. Opposition requires inventory, and inventory no longer existed in any size that mattered. The metal had been leased, swapped, rehypothesized, and promised to multiple parties simultaneously over years of fractional reserve bullion banking. The crash flushed paper promises out of existence, but metal does not panic and does not liquidate. Each green candle that appeared on the chart forced every risk model in the system to recalculate from scratch. Those models had been built for normal markets with deep liquidity and predictable behavior. This was not normal in any way that mattered. This was terminal stress being applied to a system that had never been designed to withstand it. When silver finally exceeded the pre-crash price and kept climbing, the message was impossible to misinterpret. The market had rejected the institution's last serious attempt at maintaining control over price. Funds that barely survived the initial crash re-entered the market as buyers within hours. Survival bias had flipped their entire positioning from defensive to aggressively long overnight. The squeeze accelerated because time was running out on delivery obligations that could not be extended or renegotiated. Delivery dates are written in contract law, and contract law does not negotiate with desperate banks. Exchange inventories showed absolutely no sign of relief or stabilization as the days passed. They continued to drain at an accelerating rate, pulling metal out of the system faster than any new supply could arrive. Backwardation widened across the entire futures curve despite price rising sharply. Backwardation at rising prices is one of the loudest physical scarcity signals any market can produce. Every public attempt to explain the crash and the subsequent rebound failed to satisfy anyone with real market knowledge. Privately, behind closed doors, the risk desks understood exactly what was happening and what came next. This was not a rally driven by sentiment or momentum or technical breakout. This was a run on the system, and runs do not reverse politely or offer second chances. The $15 crash will be studied by market historians for decades as a turning point. It proved beyond any reasonable doubt how desperate the institutions had become to maintain an illusion that was already gone. Desperation of that magnitude always precedes surrender in any leveraged system, and the surrender in this case had already begun pricing itself into the market before most people noticed. By the time the trading session ended, silver had closed firmly in the green. The psychological damage inflicted on every institution that participated in the crash was permanent and irreversible. No trader who watched that rebound unfold in real time will ever believe in easy short positions against silver again. Fear had changed sides completely, moving from the bulls to the banks. The squeeze no longer required retail enthusiasm or social media momentum to sustain itself. It fed entirely on institutional exits, each one pushing price higher and forcing the next exit to happen sooner. Each institution that exited its short position pushed price higher by measurable amounts, which triggered the next institution to exit. This is precisely how cascading liquidation events form in thin markets. The crash ultimately failed because trust in the paper system had already been broken beyond repair. Without trust, Paper contracts become worthless obligations, and worthless obligations collapse under their own weight. Silver had crossed permanently from being a traded commodity into something far more powerful. It had become a refuge, and refuges do not offer discounts to desperate buyers for very long. Volatility expanded trading ranges while simultaneously compressing the time required for massive repricing to occur. Weeks of price movement that should have taken months happened within single trading sessions. The rebound invalidated decades of suppression logic that the bullion banks had relied upon to maintain their positions. Infinite paper had finally met finite physical reality, and finite reality won without negotiation. Every green candle that appeared was actually a margin call hiding in plain sight. Losses were compounding invisibly across every short position still open in the system. Institutions had stopped fighting the price tape entirely by the end of the session. They had shifted completely from suppression mode into damage control, trying to minimize losses rather than prevent them. Damage control, in a short squeeze, means buying back risk at any available price. Buying back risk at any price means higher prices, which means more damage control, which means still higher prices. The squeeze was accelerating not from hype, excitement, or retail enthusiasm. It was accelerating purely from mathematics, from the gap between what was promised and what physically existed. Math does not care about opinion, sentiment, or institutional reputation. Math always wins, and it always collects, eventually without exception. The crash was supposed to reset market sentiment and restore confidence in the banking system's ability to manage precious metals prices. Instead, it reset the entire system itself permanently. Silver emerged from that session stronger than it had ever been because it had passed the most violent stress test the market had ever applied. Paper did not survive that test. What cannot be shaken by $15 crashes becomes the dominant force in any market. Silver had proven itself completely immovable when it mattered most. The market learned a lesson that day which will never be forgotten by anyone who was present. Down moves in silver no longer meant safety. They meant opportunity for those who understood what was happening. Safety now existed only in physical possession. Possession meant holding bars, holding weight, holding something that no algorithm could liquidate and no bank could rehypothesize. The rebound forced a repricing of trust itself across every financial market connected to precious metals. Trust migrated permanently from screens and contracts to physical bars and vaults. Institutions watched helplessly as the squeeze continued to mature beyond any point of intervention. There was no lever left to pull, no tool remaining in their arsenal that could reverse what physics and mathematics had already decided. Every future crash attempt will now invite immediate and aggressive buying from those who watch this session unfold. That asymmetry is fatal to any institution still holding short positions. The $15 drop will be studied, analyzed, and referenced for years as the moment containment ended permanently. Containment fails when inventory disappears, and inventory had vanished completely. Silver's green closely wrote risk assumptions across every asset class connected to monetary systems. Volatility had become bullish, which is a condition that traditional models cannot process. Each future dip will be shallower than the last and shorter in duration. Time now favors the holders, not the institutions, and that shift is irreversible. The squeeze feeds on delay, on hesitation, on the institutional tendency to wait for better information before acting. Delay defines how institutions operate, and that delay is now their greatest weakness. What began as an engineered crash ended as a declaration of war against the paper system itself. The market chose metal over promises, and that choice will echo for years. Analysts will argue about causes, motivations, and technical explanations endlessly in the months ahead. The outcome, however, is already decided and written in permanent ink. Price is the final judge in any market dispute, and Price spoke with absolute clarity that day. No interpretation was needed, no translation required. The rebound was not emotional, not driven by sentiment or retail excitement or social media momentum. It was mechanical, driven by the relentless mathematics of supply that no longer existed, meeting demand that would not stop. Mechanics do not care about anyone's opinion or anyone's position. They execute relentlessly, without mercy, without pause, without negotiation. Institutions are done because they arrived too late to understand what was happening. Being late in a leveraged market does not mean losing money. It means being finished entirely. The squeeze accelerates because exit doors are shrinking by the hour, by the day, by every delivery notice filed. There is no orderly unwind available, no graceful exit remaining. Every single ounce removed from the system increases the pressure on every remaining ounce still theoretically available. This feedback loop is merciless and self-sustaining. The crash exposed the illusion of market depth that had fooled traders for decades. There was no depth. There was only leverage wearing depth like a costume. Liquidity itself was a costume worn by leverage, convincing everyone that deep markets existed when they did not. Once that costume was removed, the truth underneath was brutal and undeniable. Silver now trades with memory. The memory of what happened when institutions tried their hardest and failed completely. Memory of betrayal hardens markets permanently. The next move will not ask permission from any regulator, any central bank, or any institution still clinging to relevance. It will arrive violently, without warning, without negotiation. What follows this squeeze is repricing across every market connected to trust, to currency, to the concept of value itself. Silver is only the first domino, and the others are already leaning. The institutions understand privately what is coming next and what it truly means for their legacy short positions across every exchange. Publicly, they remain silent, offering no guidance, no explanation, and no assessment to the markets they claim to protect. Silence is the loudest form of admission available in any market, and the institutions know this better than anyone. And admission, once made, even silently, even privately, ends the game permanently and without any possibility of reversal. The $15 crash failed because reality intervened with a force that no algorithm, no bank, and no coordinated institution could override or delay. Reality always collects its debts, always, without exception, without delay, and without mercy toward anyone who owes. Silver did not merely survive the crash, it weaponized it, turned the institution's own coordinated attack into the undeniable proof that destroyed their credibility forever across every market on Earth. It has arrived, it is accelerating beyond any point of reversal, and it will not stop moving until the mathematics of finite supply meeting infinite demand is finally and completely satisfied.